What's going on, ladies and gentlemen? We had that big catalyst this morning, and it was surely a big one. AMC is down about 5%. The broad markets are pretty clapped as well. The Nasdaq down over 2%. So we're going to go over exactly what happened with the CPI, what the main points are to know, as well as we do have some escalation as far as Russia and Ukraine. That is definitely not helping this situation. We also have some news that AMC just came out with that is very bullish. So let's get into this video. If you guys find value out of it, hit the like button and subscribe to the channel. If you guys want to support the channel as well, get yourself free stocks, links down below in the description. And right now, using my link for Moomoo, if you sign up and deposit $1, you will get 3 free stocks as well as 1 additional free share of Moomoo. And then if you deposit $100, you get an additional 2 free shares. So check that out if you guys have not already. And if you guys want to come trade with us, link down below in the pinned comment to do so for that one. So first and foremost, I do want to point out yet again that we have a strong demand zone under $15 per share. So what do you notice about today? You're down, but you're really not going under $15 for an extended period of time. It's simply not happening. You're seeing a lot of support at $15 per share. We're currently at $14.98. And we did hit $14.78 was the lowest point, but you're just seeing so much demand under 15. It's pretty hard to get us under 15 and to stay under 15. I simply don't think it is going to happen. That's my take on it. I think that's a fair fundamental valuation, and there's enough valuation there to support anything under 15 per share. So I don't think it's going to happen. We could go into that briefly if we do see big fear days like today, and that's pretty much what you're seeing, slightly under 15. By the end of the day, we will close higher than 15. I would bet my money on that one. Now let's get into the actual catalysts that are happening today. What happened with CPI, Ukraine, and Goldman Sachs actually. And then we'll come back to the technicals and everything else, AMC specific. So CPI, inflation rose 7.9% in February as food and energy costs push prices to highest in more than 40 years. The key points: the consumer price index for February rose 7.9% from a year ago, the highest level since January 1982. Excluding food and energy, both of which moved sharply higher during the month, core inflation still rose 6.4%, in line with expectations, but the highest since August 1982. Gas, groceries, and shelter were the biggest contributors to the CPI gain. Auto prices eased, which that's definitely a good thing because that's holds a good percentage of the actual CPI reading. But this next reading is going to be terrible. This next reading is going to be horrendous because CPI is backwards looking. So the data that we're getting right now is actually for February. It's not up to date in throughout, until today, right? So it's not including March. And that's really where you did see a lot of commodities go crazy: food, gas, all of that. And gas, the national average is $4.35 per gallon. It's tough out there for the bank accounts at the pump, but nonetheless, it says worker paychecks fell further behind as inflation-adjusted earnings dropped 0.8% in February, contributing to a 2.6% decline over the past year. Which all of this is not good for the markets. Why is that specifically? Well, because a lot of this inflation we are seeing because of geopolitical tensions is really unaddressable. Like Fed Jerome Powell said at his Senate hearings just last week, he basically said that we control the demand aspect. If there's a lot of demand, that's where the Fed comes in and can raise rates and soften that demand, thus bring down inflation. Well, when it's a supply problem or a geopolitical problem, Fed Jerome Powell can't order companies to drill more oil or to grow more wheat, corn, or sunflower oil. So in that sense, the Fed is powerless to do anything. So that's why this next meeting next week for March 16th is going to be very important, because investors want to know, like, hey, do you guys care about this geopolitical inflation? Are you guys going to react more aggressively? How are you guys going to navigate this? Because this is going to be the hardest soft landing that has ever been attempted. We've never lived through this scenario. You have to go back like 30 years to see anything like this. And in the 70s, it was anything but a soft landing. So we've never seen a soft landing before, and investors are definitely going to start talking about that a lot more, and that's going to be a big fear sentiment in people's minds. Now, some of the other news, this is really what I think is dropping the market substantially today. It says Ukraine foreign minister says Russian officials live in their own reality after talks fail. The key points. Talks between Russia and Ukraine's foreign ministers in Turkey on Thursday ended in failure. The discussions between Lavrov and Kuleba lasted just 1.5 hours. Ukraine Foreign Minister Kubala's comments came after Russian Foreign Minister earlier denied that Russian forces had targeted civilians by bombing a children's hospital and maternity ward on Wednesday. That's all we really got out of this. There was a lot of talks about potentially having a ceasefire, and that would give you the biggest rally you've ever seen in the markets, more than likely in a single day, if there was a definitive peace agreement or ceasefire agreement that was announced. But that seems highly unlikely. After Russia has pretty much lost everything financially and economically, they have to have a win in Ukraine, no matter if they lose 50 or 100,000 troops taking the whole country. You really just lose on all sides if you lose militarily as well. So I don't really think that's coming, and I do think, a lot of the drops in oil, a lot of commodities really going down is people expecting this to end soon. But unfortunately, I don't think it is going to. So you're going to have this nagging on the markets for quite a while. Some people are talking about this is going to take years. If it takes years, commodities, oil, uranium, everything is going to go up, and it's probably going to stay up for a while. Now, this was very interesting as well that I did want to bring to your guys' attention. It says Goldman Sachs shutters Russia business, first major Wall Street bank to leave after Ukraine war. The key points. Goldman Sachs said it is exiting Russia, becoming one of the first major global investment banks to do so after the country invaded its neighbor Ukraine last month. Most big U.S. banks had modest operations in Russia, a geographically large nation with a relatively small economy. Goldman was estimated to have $940 million in total exposure, or less than 10 basis points of its total assets, according to Bank of America analysts. While New York-based Goldman is shuttering its operations in Russia, it still facilitates trades in debt securities tied to the nation. So if that gives you guys a glimpse into Goldman's exposure here, $940 million. So they lost over half of that, if not all of that. So they're down a couple $100 million. For Goldman, probably not a huge deal. But some other banks are even more exposed, like Citigroup has $10 billion of exposure in Russia, and that's about 10% of their total market cap. That's why banks are not really doing the best, especially on these down days. You do tend to see banks getting beaten down quite a bit. And like I've been saying, this Russia situation is going to hurt everybody. But the banks especially, they have a lot more exposure, direct exposure and indirect exposure than you would think. Now, direct exposure would be the banks investing in these companies, buying Russian treasuries. Indirect exposure would be the banks lending to hedge funds that have direct exposure to Russia. So either way, the cookie crumbles here. They have a lot of exposure, and you're definitely going to see this credit event playing out throughout the rest of this year. You've started to see other investors talk about a potential credit event coming. Word on Wall Street is that that is going to happen here in the next 3 to 6 months as all of this Russia situation, all of the stocks going down, bonds going to zero, all of that is going to start to take an effect, as well as China and their real estate market going down, as well as investments in Chinese real estate and other segments of the Chinese economy, as well as possibly in America, but America's balance sheet is pretty good. Shout out to the money printer and Jerome Powell for that one. Now, that's the major news. as far as AMC, it says AMC now accepts numerous cryptocurrencies on their website, according to their CEO. And you definitely, when this came out, you did see a pop in AMC, and you've seen this kind of continuing rally that's happened ever since. So that is really good, and we are now above $15 per share yet again at $15.26 per share, down about 2.8%. So I think this just goes to show that any little catalyst here is going to keep us above $15 per share, or just in general. And this is exactly what we want to see. We want to see these kind of catalysts when you start to see that credit event, when you start to see capital really being restricted by hedge funds losing a lot of money elsewhere. When they lose money, when banks lose money, they have less money to service their margin calls. When AMC starts to pop and rally like this, then when they get that margin call, they don't have that money to service that margin call, so then they cover on their short positions, drive the share price up, then other hedge funds do, and that is a domino effect driving the share price through the roof. So that's really it as far as geopolitical news and AMC is concerned. Now let's get into specific AMC data and then the technical analysis. So for the Ortex data, we are looking at 20.74% short interest of free float, 106.8 million shares that are sold short today. Cost to borrow max is doing some weird shit here, 2.32%. It was just saying 4% yesterday, and I'm very surprised the cost to borrow max is not 5 or 10%, because the utilization is still at 100%. Nobody wants to lend out their stock for 2.3%. That's very obvious here. So the cost to borrow max in theory should be going up, but it's not. So very weird. Utilization still at 100%. So that is definitely a bullish sign by my definition. Days to cover is at 2.62. So also hard for shorts to get out of their short positions. And like I said in the last video, the exchange reported short interest data did come out yesterday for sentiment day, February 28th, and the short interest of free float was at 19.79%, so pretty much 20%, kind of where we are at right now. And days to cover is the biggest jump there, going from 1.75 days to cover to 2.5 days to cover, and that is showing less volume, and that is telling you that it is harder for shorts to get out of their short position now than we have seen really since back here in November. So situation looking very good in the aspect of the short squeeze here. As far as the max pain, that is $17 by the end of this week. At this pace we're going at, it would not surprise me to go to $17, $18 by the end of this week. And the Stocko tracker data, this is really exciting. I really don't expect anything throughout the rest of this week, where it is still possible to see one of those mega bounce like scenarios playing out tomorrow if we see a big green day in the markets, or just AMC has a really good day, because you are looking at 4,400 calls that are in the money, 137,000 calls that are out of the money. For in the money puts at 37,000, out of the money puts at 33,000. If you do see that rally, you have a lot of calls that are out of the money that could run into the money really at every expiration now until about that $25 strike for this Friday. So if you see that happen, there's today and tomorrow until those contracts expire. So if you see that move here in the next really 1.5 trading days, then you will see instant hedging that has to happen, and that's where you can see gamma squeezes or mega bounce days where you go up 10 to 20% on Thursday or Friday. I'm really not expecting that, but it is possible. For next week, that's where I get a little bit more excited. So we have 6,000 calls that are in the money, 333,000 calls that are out of the money. That is an insane ratio. There's like 1% of calls that are in the money compared to out of the money. Is that 2%? I think it's 2%, rough math here. That's a very, very small amount for any stock, but nonetheless, a stock like AMC that can be very explosive, that is dangerous for the shorts in AMC. And I do expect there to be some kind of bounce next week because of that. Even if 5 or 10% of these contracts go from out of the money into the money, you're going to see a pretty aggressive rally. Nonetheless, if 25 or 50% of these go into the money, you're going to see a huge rally. On top of that, what is even more exciting is puts that are in the money is sitting at 85,000. That is 8.5 million shares that would have to be hedged for if AMC does go up. And a lot of these puts are at that $20 strike. So if AMC goes above $20 per share, hedge funds have to instantly de-hedge these short put positions, and that does consist of buying stock on the open market. So I am very excited about that. I will go through a deep dive video into a possible gamma squeeze later on today for next week, so you guys definitely want to stay tuned for that one. As far as AMC in the actual technical analysis, I'll pull this out to the daily candlestick chart. Like I said, a lot of demand under 15, so we can periodically, see the wicks of these candles go under 15, but you don't stay under 15 at all. We really haven't moved anywhere in the last month, really since February 7th, or really even back here since we started to sell off. We haven't really done anything. We've went up and then came right back down. It's like a literal wave right now, and I do expect, since we are at the bottom end range like we've seen over the past 3 bottoms we've seen, you will see a move back up to the upside, but we do need to break out above that almost $17 level and then really get above $18.50 again to start talking about potentially breaking out past 20 and going above that $21 level. Like we've seen right here, it was a little bit of resistance, so I would expect it to be, but I don't think it's going to be a huge problem if we do see that rally next week and we see that gamma squeeze, because of the amount of options, the calls, and the puts that are in the money that would consist of market makers buying the stock on the open market. So if we do see a move next week, it could be really good. 20 days simple moving average is at $17.52, so that shouldn't be too hard to break out above, in my personal opinion. Volume is still very low, only 16 million shares that have traded hands today, 25 million shares yesterday. So this is exactly what I want to see, is less activity in the stock, because I personally don't like to trade stocks that are super crowded. CEI, it's one easy example here. I've got a lot of people like, hey, why don't you buy this stock or trade this stock? It has too much attention. I like stocks that don't have as much attention, and AMC is getting to that level where it has less attention now than it really has had in the last year, and that's where you can actually see the biggest gains. So very exciting about that. The RSI is at 38.52 as well. Thank you guys for watching. I got a terrible 2-year-old, got to get to her. Thank you guys. Get yourself free stocks, links down below in the description, as well as join the trading community pinned in the top comment down below. Shout out to all the dads out there. Thank you guys for watching. I'll see you in the next one.